So this is an explanation of a short explanation of Mr. A, who is 32 years old, a software engineer, single, has a marital status. So the annual income of Mr. A is 4 million per annum. Let's say 4 million naira per annum. He has a savings account with a total amount of 1 million. And the choices of the sector is the industrial sector, where they produce industrial goods, oil and gas sector, banking and finance sector, hospitality sector as well. So Mr. A wishes to retire when he's 65 years old. So when you deduct 65 years old from 32 years old as the current age, you can have a time horizon of investment of 33 years of investment. So this means that we have the time horizon of investment for 33 years. So he wants to invest a certain amount of money, which is 1.5 million naira. So that's the amount available for investment, which means that whatever we're doing, we're not going to add any more money to the 1.5 million. So this is the amount available for investment for the period of 33 years. Now, from the investment policy statement we got from Mr. A, we discovered that he wants his expected return to be as much as 20% and his allowable risk to be as low as 10%. So he doesn't want to lose more than 10% and he wants to make up to 20% guaranteed. So there's a clear reason why you're doing better than your peers. And the reason is because you are investing while your peers are saving. So when you save money, what do you get when you save? You get a bundle, or you get a pack, or you get a stuff of the money you've saved for over the years or for that period you've saved. So when I'm investing my money into shares, into crypto, into stock market, let me say, or into the financial market, let me say, and someone else is saving, there's a tendency that I'm going to make 100% or more than 100% of what I've invested than someone who is saving 100% of his savings in an account for just a little as 10%. So as a financial analyst or a financial advisor, financial investor, it's not up to you to give him the choices, a series of options you can invest such amount of money with considering the expected return and the allowable risk. You understand? So the difference between someone who is saving and someone who is investing is that you're making the right financial decision while the other person is making the wrong financial decision. I can tend to make 200% of what I've invested than someone who has invested 100% of his money in an account that's just giving as low as 10%. Because you invest in an account that's a certificate of deposit, you tend to get your returns maybe at maturity, just like a commercial paper. But the only difference is that it's fixed though. Yeah, it's fixed. But it doesn't correspond with what's happening in the financial market. It's just the bank saving your money, keeping your money for as low as 10%. Where I can save in a mutual fund, I can invest in a mutual fund, I can invest in the stock exchange, I can invest in the bonds, I can invest in the commercial paper, I can invest in the treasury bills. And this is what Mr. A is trying to make. Mr. A is trying to invest in the stock markets. He's trying to invest in the markets where shares can correspond. Share can consider the market sentiment that's going on in the environment where it's investing. So the next sheet explaining the investment that we've captured for Mr. A. So from the first sheet here, we've got details of Mr. A's statement. So take it for example that Mr. A is trying to invest into stock market, and we know already that the sector choices that he needed is just the industrial choices, oil and gas sector, the banking and finance sector, and the hospitality sector. So currently now, this is for industrial goods, banking sector, banking and finance, this oil and gas, and this hospitality. So Boa Cement is for industrial goods, Zenith Bank is for banking and finance, Ohando PLC is for oil and gas, and Transcorp Hotels is for hospitality sector. So I included the XYZ just to complement this amount to the 2 million naira. So this particular column here is for the new price. So this is for the new price. If Mr. A is actually buying today, this is going to be the new price as of today. So it's going to have total shares of 41,000 altogether for the 5 units, for the 5 companies, and everything together is going to be like 2 million the dots. So the old price, sorry, I've already done some calculations here, so I'm going to put it through. So the old price comes in this way. The old price it's just like all the market sentiment, the ups and downs, the political news, the economical news, the trends, the information coming from the banks, coming from different companies, wars in different companies and different nations affects these share prices. It definitely affects share prices. So if BOA of 143.20 for us today, yeah, so it's 143.2 naira per share, so there's guarantee that it can't be like the same price when it's like the next coming days or the next coming weeks. So any shifts or any drop or any upward trend in all the units of BOA, Zenith Bank, or One Transcorp will definitely reduce the total sum here. Definitely reduce the total sum of Mr. A at the end of the day. So if you have the current share price to be at 100, I want you to pay attention to this green cell here, the 187,0400. So I just want you to pay attention to it. I'm playing with figures now to just see what's happening to Mr. A's shares. So basically, a drop in BOA Cement is going to affect the total share amount held by Mr. A. It's definitely going to affect the total share amount for Mr. A. So doing this is I deducted the total amount of share of the new price from the old price. Okay, I deducted the total amount of the new price from the old price to get me the 279,600 that we have here. So I'm just put this in red field and bold it so you can see it clearly. So let's assume the old price for Mr. A is 150. Okay, if the old price for Mr. A is 150, this means that Mr. A has gained 20,400 in just BOA alone with the same unit purchased, but the difference is just coming from the current share price. So the current share price is the determinant of what's going to affect the shares return in total. So for example, let's move to Zenith Bank. If Zenith Bank at 2.5 is maybe the old price is 20, you can see how much he has lost. So the risk and return of Mr. A is going to be determined by the share price, because the share price can fall and the share price can also move upward. The unit can be the same, but the amount of shares will definitely change, and it will change with the share price. So the unit is going to be the same, but the amount is going to change with the share price. And times where the unit is not going to be the same is that the worth of what the new price can buy with the total amount of share purchase is going to be like interchanged with themselves along the line. So the new price for Zenith Bank is 32.5 and the old price is 15. You can see now that when you add 20,400 naira to 210 to negative 210,000, you have 189,600. So literally, he hasn't gained any amount, like tangible amount of money. So take note that this new price doesn't have any risk or return, because this is just the price as at now, as at today. So going by Oando, if it's 9.5 per share, he has lost 15,000 from this return. To Transcorp, if it's 80 naira per share, he has lost 147,900 from this return. And while the XYZ company, if the share is 62 or 65, he has lost 362,500 from this return. So along the line, the number of years you've been trading or you've been holding your shares is going to determine whatever you're going to gain in the coming years. So, and in investing, history repeats itself. There's tendency that what happened 10 years ago is going to happen now. Okay, so this is just on the red side now. This is just on the share risk affecting BOA, Zenith Bank, Oando, and Transcorp. So if BOA is over the new price, which is 200 per share, and Zenith Bank instead of 15 we have 40, you can see the figure here is changing, and Oando instead of 9.5 we have 15 is gaining now, and Transcomputing instead of 80 we have 100.2, and XYZ instead of 65 we are having 93. So automatically the new price of this is going to be the new price now. The new price of Mr. A is going to be all this, whereas the return has changed from 2 million that he invested in the first date to 2.4 million. So he's gaining the total sum of 400,000 in his return, in his share return. This is how the stock market works. So if Mr. A, who wants to invest 2 million naira, that's the available amount for investment, is 2 million naira, and he needs this money to be in the account for the period of 33 years. This might be just for like day changes of price. So it's possible you can have another change where this could be 100, okay, this could be 60, okay, this could be 11, okay, this could be 78, okay, this could be 13 or 12 or whatever. So this exposes Mr. A to risks of what the price changes, because the price is going to continue to change. So the 2 million that I invested in the first date has dropped to 1977 million. Okay, so the volatility in the stock markets is very high because of the rapid or the slow changes that's happening in the country. The different things happening in the country, the inflation rates, the interest rates, it could be strike, it could be war, it could be suspension from the government, it could be anything. So the market reacts to all this news. It could be competition from their peer companies as well. So the market reacts to this news, and when the market reacts to this news, it causes changes in the prices. That's what makes the stock market to be highly volatile. Thank you.